Welcome everybody to our, I guess it's sixth financial planning workshop. These are sponsored by the local Silicon Valley chapter of the American Association of Individual Investors, the AAII, along with the Los Altos Library that provides this room for us. Tonight we're going to be talking about managing your cash flow in retirement. My name is Fred Smith. I'm a retired registered investment advisor and financial planner. Giving you my email address up there in case folks have any questions or anything after the workshop tonight, or at any point if you want to explore anything in more detail. I'll be glad to work with you on it. And welcome also to those folks who are tuning in on our webcast tonight. I've given on the screen here the details for anybody else that would like to join us by webcast. If you go to our local Silicon Valley AAII.org, it tells you how to sign up for the webcast for the future ones. And also the slides for tonight and a recording for tonight will be available on that website. As I said, this is the sixth workshop in this series. The first four were on investing, various aspects of investing and building a portfolio, and also the final wrap-up on that was the argumentative active versus passive investing strategies, which got some good discussions going. Then we have three on retirement planning. Last month we did some of the preliminaries on retirement planning, and tonight we're going to be getting into some cash flow issues, and next month we'll be dealing with the withdrawal rates. Most folks are familiar with Bengen's 4% rule. We'll be going into that in some detail along with a bunch of other stuff. And then the final two workshops deal with Social Security and Medicare, which is actually a lot more complicated than most folks realize. I think there's a fair amount in there, and there's plenty of opportunity to make mistakes on those if you're not watching what you're doing. And then the last one is on estate planning. I'm not an attorney, obviously, and I'm not going to get into any legal issues on the estate planning one, but mostly I'm going to be discussing some of the practical aspects of estate planning and what it means to be a trustee and stuff like that. So that's where the whole program works out. And the last session I think is in May of this year. So today we're going to cover cash flow. It's basically income and expenses. The income is the traditional three-legged stool. The folks have talked about for ages: Social Security, whatever pension plan, if any, that you have, and then finally the income that you can generate from your retirement portfolio. And then we'll be looking at how you control your expenses and group them together and handle them. It may not be obvious at this point how the rest of the items in this slide fit into tonight's topic, but you'll see as we go along why they're there. We're going to be talking for a few minutes on reverse mortgages and also on annuities. And then finally we'll wrap up with some discussions on what I consider the two big train wrecks, potential train wrecks if you're not careful. That's long-term care insurance and liability issues. So that's the agenda for tonight. Feel free to stop me at any time to raise any questions. This is a workshop, not just me standing up here spouting at you folks for 2 hours. Whatever questions you have, somebody else may have be wondering about the same issues. So don't be afraid to speak up. And those folks that are on the webcast, I think Alan's already told you how to sign in or write your questions in through the chat box, and we'll try to respond to them here if we can. As I've said here, the whole notion of retirement planning is really an oxymoron. The first part of it's easy, the accumulation phase. We all spend 30, 40 years, saving X percent per month and being diligent little squirrels, and that all works out fine. And that's easy enough to put the numbers on. It's straightforward number crunching. You know your age. You know what, if you're not already retired, you know when you plan to retire. You know how many dollars you're going to need, what savings rate you're going to have to do to get there, and all of that. That's just putting numbers into a spreadsheet and crunching them. The distribution phase, after you've retired, is a lot more difficult to foresee, to get your arms around. What I call the known unknowns in there. The first thing is we don't have a clue about the duration of retirement years. For somebody who's currently age 65, the actuarial wizards will tell you that you've got 18 to 22 years expected life beyond that, which puts most folks into the mid-80s as the average. Men tend to be in the earlier end of that section, and women live a few years longer on average. But those are just averages, and you may well live 10, 15 years beyond the average, so you can't go working just on the averages. We don't have a clue about the retirement on the portfolio. We know that for the past 20 years, the S&P has averaged about 10% per annum, or if you have a halfway decent diversified portfolio, you get about 10% per annum and try to control the volatility a little bit. But that was then, and this is now, and things may have changed. So there's no guarantee that the next 20 years are going to have anything at all to do with the last 20. We just don't know. There's an issue that comes up that a lot of folks overlook, and that's the sequence of return risk. Basically, any downside volatility in your portfolio within a few years just before retirement or a few years just after retirement, within that fairly well-defined, let's just say a 10-year window centered around your retirement date, any downdraft at that point has a much more significant impact, a negative impact on the longevity of the portfolio than the same downdraft would have at any other time. Basically because you don't have the opportunity to recover from it, and you've still got the maximum 30, 35, 40 years of life that you hope to have ahead of you to have the portfolio last. So you're at the maximum risk at a time when you've got minimum ability to fix any problems that occur. So that sequence of return risk can be very, very significant. The other thing, of course, that we don't know about are our health issues going forward. Just because we're healthy at this point doesn't mean that 10 years from now we're going to be able to do all the things we thought we could. And the medical expenses may get, medical expenses are actually going way ahead of inflation for the last few years, last decade or two, probably, and there's every reason to continue to think that may well continue. So medical expenses could be a major, major issue in the future, just adding to the known unknowns. And of course, the ultimate that is you get to the point where you need long-term care. Now you're talking about some significant dollars, and it could be for an extended period of time. So putting it all together, the distribution phase is just pockmarked with question mark potholes. There's all sorts of opportunities for unexpected outcomes. Sure, absolutely. The question is that why is the period centered around your retirement age considered a particularly bad time to suffer a downdraft? The main thinking there is that just as you retire, you are forfeiting the ability to work your way out of any hole that you get into. You no longer are working, so you've given up that income stream. You've still got 30 years, 35 years, or whatever ahead of you that you need to make the portfolio last. So if you get into a downdraft at that point and you're pulling out, you say Bengen's 4% fixed time, you're pulling out, you're giving up a bigger chunk of your portfolio in absolute terms, than you might want to that early in your retirement, and therefore not have the ability to recover from it. If it occurs 10, 15 years later, you've already gotten through you're safely through the first 10 or 15 years, and if there's a downdraft, then you no longer need to have it last 30 or 35 years. If it lasts another 10 or 15 years, if you can see your way to getting through the next 10 or 15 years, it's a little bit safer, a little bit easier to deal with. Does that answer your question? Sort of. We'll talk afterwards if you like. Come talk to me afterwards. Okay, so where does the income come from in retirement? There's the three-legged stool that everybody talks about. Start out with Social Security, and for most people, that's not a complete stream to take care of your spending in retirement, but for most people, it's still a significant chunk of it. Some people have pension plans that kick in at that point. Some don't. It depends on what you've been doing during your working career. And then finally, those folks that where the first two are not adequate, hopefully have a good retirement portfolio built up and will be drawing that down over through their retirement years. So those are the traditional three legs of the stool that supports your retirement. I'm going to be talking about Social Security in a lot more detail in a couple of months, but I want to just cover it real quickly here. First of all, you have to have worked for at least 10 years to be eligible to draw anything out of it. The concept of full retirement age, FRA, is a fundamental concept in Social Security, and for most people, the full retirement age will be either 65, 66, or 67, something in that narrow window, depending on the year in which you were born. It's actually equal to 66 even for those folks born between 1943 and 1954, and it's a little earlier than 66, going back to 65 for folks born before 43, and between 66 and 70, it gets ratcheted up for those folks born after 1954. The other concept that you need to understand clearly is the primary insurance amount, the PIA, and that's the amount that you'll receive at your full retirement. If you retire actually and start drawing benefits right at your full retirement age, the PIA is the amount that you would receive. And the way that's calculated is that the Social Security admin takes the last takes your total working career, all the contributions you made into it year by year by year, and looks at the best 35 years and then averages that. Now that means that if you got if you've worked say 40 years and there's some poor years, they'll get thrown out. If on the other hand you've only worked 20 or 25 years or something, if you've not worked for 35 years and don't have a 35-year record, the Social Security admin will backfill the empty years with zeros. It's not a pretty sight, because then that obviously brings your average way down. So those folks that are looking at retiring somewhere around the 35-year mark need to think as to whether there are some poor years in there that they'd like to work a year or two longer and crank up the average. Two concepts that show up in calculating your Social Security benefits are early and late retirement. You can retire as early as 62 if you want to, if you choose to, but there's obviously a penalty to do so. The SSA will ding you 6.3% per annum for every year that you retire before your full retirement age. So somebody that retires at age 62, if their full retirement age was 66, would get about 75% of their primary insurance amount. And that 75%, that cutback lasts all the way through for the rest of your life. You're looking at that 25% discount off the full retirement amount. On the other hand, if you work longer than your full retirement age, you get an 8% per annum increase. Now, up to age 70. It doesn't go beyond age 70. There's no point in working beyond age 70 just from the perspective of the Social Security, because there's no additional increase. But if your full retirement age was 66 and you elect to work until 70, you get 4 years worth of 8% per annum, or another 32%. For waiting until age 70 to retire. And that's obviously a nice benefit to have. That's particularly true, we'll see in a minute, for those folks for who are married. It's a good plan to try to take the higher earning spouse, maximize their benefits by delaying retirement if possible. Social Security also provides additional benefits, spousal benefits, equivalent to half of the working spouse's benefits. For a stay-at-home spouse, for example, that never worked a day in his or her life, is entitled to half of the spouse's benefits. If one spouse passes away, the survivor benefits are equivalent to the full amount of the working spouse benefits, and it's actually the higher of the two working spouses, regardless of which spouse dies first. It kind of works kind of like a joint annuity, where regardless of which spouse dies first, the benefits continue for the second spouse. And in the case of Social Security, it's the benefits for the higher earning spouse, even if it's the lower earning spouse that survives. The Social Security Office doesn't actually doesn't calculate it quite that way. That's the net effect of it. What they actually do is say you're entitled to your own benefits, and if your spouse was entitled to a higher benefit, we'll give you the delta as well. So it's basically your own benefit plus the delta if it's appropriate. But it means in practice that you get the benefit of the higher earning spouse. Social Security also offers benefits for divorced spouses, child benefits, disability inputs or incomes, and a death benefit. I'm not going to get into any of those because they're somewhat incidental, and we certainly don't have time tonight for them. Strategies that may apply for claiming Social Security. Some of you folks may have heard about filing a restricted claim. A restricted claim allows a spouse to claim benefits at full retirement age to age 70, to take just the spousal benefits and not his or her own benefits, and then let your own benefits grow by the extra 32% up to age 70. The claiming spouse has to have reached the full retirement age, and the working spouse must be actually receiving benefits already or have filed and suspended. We'll talk about that in a minute. The problem with this whole strategy, this was great for many, many years up to October of 2015, just over a year ago, when the Bipartisan Budget Act killed it for a lot of people, not everybody. And the reason I've left it in here tonight is because it will still apply to some people. If the spouse has reached age 62 before December the 31st, 2015, in other words, just over a year ago, then this strategy will still work. The spouse can still claim spousal benefits only, if he or she chooses so to do. If the spouse was not old enough to reach age 62, a year and a couple of months ago, then this is no longer on the table. The Bipartisan Budget Act of 2015 killed it for you. Sorry about that, folks. I know this is our government. We're here to help you. Strategy number 2 talks about the file and suspend strategy that I mentioned briefly in the last slide. With the file and suspend strategy, you can file at the full retirement age. You're going to the Social Security Office, tell them I want to file for my benefits, but oh, by the way, I want to suspend the benefits right away. And it's for the perspective of the person doing the file and suspend, it doesn't, it's the same as if you never showed up at all. Your benefits gained at 8% per annum through to age 70, as if you had waited without doing anything. But the big thing that it does do is allow your spouse, if he or she qualifies based on the last slide that we talked about, being age 62 before the end of last year, it allows him or her to file for spousal benefits only. And again, the Bipartisan Budget Act of 2015 killed this strategy unless the working spouse happened to be old enough to already have filed and suspended by April 29th of last year. So that's history for most folks, or for everybody at this point. You either did do it or you didn't do it. If you did do it, congratulations. If you didn't, I'm sorry, you're out of luck. Final thing I want to talk about on Social Security is basically the strategy of optimizing the benefits for the higher earning spouse. The higher earning spouse, his or her benefits will accrue to the surviving spouse regardless of which spouse that happens to be. So even if the earning spouse happens to have a short life and die early, if the surviving spouse could well live to 99, 100, 105, who knows? And if that's the case, it's useful for them to have the benefits from the higher earning spouse, even though that wasn't their own. So it really, really is worth considering optimizing, in other words, maximizing the benefits for the higher earning spouse. Again, we'll go into all of this in a lot more detail in a couple of months when we're talking about Social Security in detail. We have a question from the web.
Do you have to file and suspend if you work to 70, or can you just not file and wait to claim? It's not clear, assuming no spouse.
The question is, do you have to file and suspend to wait to age 70, or can you just not file and not suspend and just wait without doing anything, assuming no spouse? If you assume no spouse, then you may as well just wait. I don't see any benefit to filing and well, there may be some minor benefits to filing and suspending. At one point, I'm not sure if it still applies or not, if you file and suspend, it gives you the opportunity to take a Murphy and do a redo on some of the previous decisions. That may kick in at that point, I'm not sure. But in general, the biggest reason for doing a file and suspend would be to allow a spouse to file for spousal only benefits if he or she qualified. There's a question over here.
Assuming you earn a certain amount of year, 118,000, what happens if you get sick or retire before stop working and don't get benefits? So you stop working and 118,000 till 70 for your full retirement age. If your benefits go down,
the question relates to claiming benefits. If you wait until 70 and you go by your Social Security statement that some of us get in the mail occasionally still, although I think they've stopped that for most. But if you go to the website, you can check on it. It gives you the number or the projected numbers for what your benefits would be at age 70. And the question is, if you get sick or stop working for any reason, does the benefit go down? I'm not certain of the answer to that, but I believe that the numbers they give you on the web are just projections, assuming that you continue working at the same rate that you currently are. I think if you do anything to change that, then the numbers are likely to change at the end. If you quit working, then the increments will stop improving, and your projected benefits at age 70 will go down. Yes. Any other questions on Social Security before we move on? Okay. Okay, so we're going to look now at the second leg of the stool, the pension leg, and there are really two different types of pensions we're talking about. We're going to talk first for a couple of minutes on the defined benefit pension plans, the DB plans. Those used to be fairly common if you go back a couple of decades among major corporations and certainly amongst the various government agencies. Most of the corporations have moved on from that now to defined contribution plans, but there may be a few still in existence, but I think there are very, very few. With the defined benefit plan, it's funded by the employer. Makes annual contributions to maintain an adequate account that can be drawn down later to pay for the benefits, and the risk is borne by the employer. In other words, if there are downturns in the economy, or if the stock market doesn't do well, or if they make poor investments or whatever, the burden of that is all on the employer, because the employer is basically guaranteeing the employee a certain defined income through his retirement for as long as he lives. So the employer takes all the responsibility and all of the risk. If the employer goes bankrupt or something major happens, there is an insurance agent called the PBGC, the Pension Benefit Guaranty Corporation, which will step in and attempt to make the retiree whole, although I believe that they'll probably take somewhat of a haircut, but hopefully not too bad, if the employer is no longer capable of honoring their commitment to provide the benefit stream. One of the problems with these pension plans is that they're tough to administer, and they're expensive to administer, they're complicated to administer, and the employer needs to get the help of an actuarial service because they're basically looking at the number of retired employees out there and all of the data on their age and their life history and their health and all the rest of it, trying to make projections to how long they're going to live and how much, what the dollar drawdown is going to be on the plan over the next decades. And it's a major expense to administer. So that's one of the reasons why the employers tended to drop out of it, not least amongst the other reasons being that they didn't want to fund them themselves. So a lot of folks have gone to the defined contribution plans. With the defined benefit plan, the way it typically worked was that the employee was expected to draw a pension on a percentage earnings per year of service formula. That's the way it kind of worked. They'd take their salary, either for the last year or sometimes the average for the last 3 years or maybe the last 5 years, and they would multiply that by the number of years of service and by some percentage amount. They might say that, we'll take your salary, take 2%, I'm just giving an example. They might say that they'll take 2% of your salary for the average for the last 3 years and multiply it by, let's say you've been with us for 27 years now, they multiply it by 27 and they come up with the 54% number as the percentage of your final salary that you get as your benefit. In order to save money, some employers integrated this with the Social Security benefits, so before they calculate how much they're going to kick in, they're going to figure first how much the Social Security is going to kick in and use they put in the smaller delta to bring you up above the Social Security number to whatever your percentage earnings per year of service formula would give you. Some of the problems that I see with this, and this is sort of looking at it from the employer's perspective. I mean, they're great from the employee's perspective. If you can get it, good luck. But some of the problems with the system from the employer's perspective is this, a lot of employees are smart enough to figure how the system works, and they load the last year, by tossing in all the vacation time and sick time and overtime and all the rest of it to make the last year or the last years look great. And obviously bump up their benefit for the next 30 years. So there's a great temptation to do that, and it's not very tightly controlled. The other problem that I see with the defined benefit plans are that a lot of the folks, this is mostly at the local government level, a lot of the folks giving the benefit or trying to define the benefit for the employees aren't digging deeply enough to figure how much is this really costing us to do this. It's one thing to promise Joe a gold watch and $60,000 per annum as his retirement on the last day of retirement, but do they ever stop and think that if they want to promise him $60,000 for the rest of his life, they really need to set aside $1 million account to fund that for the next 20 or 30 years. And it's not clear to me that a lot of folks are thinking that far ahead, and I think the system tends to get abused. The other thing, of course, is that most folks in local government are going to be long gone by the time the problem hits. They're generating a problem down the road, and they're not going to be around to solve it. It's going to be somebody else's problem to figure how to solve it. We're seeing some of that today. I mean, Sam McCarthy is going through all sorts of tossings and turnings trying to figure out how to fund all the stuff that's been promised over the last couple of decades. So the defined benefit plans, for the most part, I think today exist only for public service employees, for police and fire departments and stuff like that, and other things at the local, possibly at the state government level. But most corporations have switched. Yes, sir. That's just a number pulled out of the air. The question relates to the $1 million that I put in as a necessary requirement to support 60,000 $1,000 pension. I'm just assuming that if somebody put $1 million into a investment portfolio today, they could expect over the next 20 or 30 years to invest that to pull 6% per annum out, which would be the $60,000 per annum. It's just an example. It's an order of magnitude is what I wanted to show there. Don't take the details of the numbers too seriously, because it will change with time. It's in today's dollars, yes. Yes. Okay, as I said, most corporations have already switched to the defined benefit plan, and the two big differences with the defined benefit plan are the defined contribution plans. Number one, they're funded by the employee. You put your own dollars into it, and granted they're pre-tax dollars, you get to take a tax deduction for what you put into your 401k or your 403b, which are very similar. I'm assuming most folks are familiar with 401ks and 403bs. Probably most people have seen them at some point or other. But you're funding them with your own pre-tax dollars, and secondly, the employee is bearing all the risk of the portfolio management and the responsibility for the investment returns. So the employer has sidestepped all of that and passed it on to the employee. I can understand the reasons for doing that, but it's a lot of folks are upset that they've lost their defined benefit plan and that they now have to work a little harder to do it themselves and take responsibility for it themselves. So, but I'm not going to go any more into the defined benefit plans now, because we're going to be looking at the income from your portfolio for the third leg of the stool, and this kind of, the contribution plans kind of fall, your 401k or 403b plans kind of fall into that same bucket. So we'll move on to the third leg of the stool. The third leg is getting the income from your retirement portfolio, and hopefully during the accumulation, during the accumulation phase, folks will have figured early enough that they should start saving early. This is preaching to the choir. It's actually preaching to your kids and your grandkids choir, I guess. Try to start saving early. If you start saving in and around your 25, 30 age bracket, somewhere in there, you need to save 15% per annum, or approximately that, so that you will have enough saved in your retirement portfolio to maintain your same standard of life when you switch over to the distribution phase. If you start earlier, I'm all in favor of having 15-year-olds start the accumulation for the retirement plan. That 15% drops to 10 or 12% or even lower as what you need per annum. For example, if your kids or grandkids or something that do a paper route and they earn a couple of $100 a year doing this, have them put it into a Roth IRA and give them, refund them, the $100, $200 themselves, so that make them whole, so that they don't feel that they're, being cheated out of their hard-earned money. But get them started on a Roth IRA right away. The other thing that's kind of important here, I've not heard too many planners. Michael Kitces is one of the financial planners who emphasize it. Most of the others don't even bother with it, is what's termed lifestyle creep. If you get a bump in your salary, don't rush out to spend it immediately. Don't bump up your lifestyle. Don't suddenly start going to fancier restaurants or taking better vacations or whatever, because you want to go into the distribution phase, into your retirement phase, with an expense level that you can control, and you don't want to keep ratcheting that up during your working years and set yourself a really high bar to maintain when you retire. So whatever lifestyle you're comfortable with at 30 or 40 years old, try to stick with it. Okay, when you get a salary bump, you can spend some of it, but don't rush out to bump everything up. During the distribution phase, actually during the retirement years, we're going to be talking about Bengen's 4% rule at the next workshop, along with the bucket strategies and some other things that apply to distribution. So I'm going to defer that until then. Okay, so How do you manage your expenses? It's just the main core of what we're talking about tonight. You've all probably come across the saying that for getting a first approximation for your retirement expenses, take 80% of your final salary. It's perhaps not a bad place to start. It certainly gives you a ballpark number to start making your estimates. And the rationale behind the 80% is that you'll no longer be making contributions to any retirement plan. You won't be paying into your 401k anymore, and you won't be trying to save your 15% into your retirement portfolio. So that will have stopped. You won't have commute expenses. You won't have to dress for work and all the rest of it. So your business cost should go down a little bit. And there's also the chance that you'll be in lower tax brackets. All of those things kind of lead to the notion that that your cost of living on the day that you retire could well be approximately 80% of your salary. I'd be wary of the last one, at the lower taxes. That could well be true, and most folks figure lower taxes as part of their retirement plan, but there are a couple of things that totally derail that. One of them is what I call the curse of the working spouse. If you retire and your spouse is still working, chances are your taxes aren't going to drop, and you may well go through quite a few years of retirement at higher taxes. The other thing is, with the national debt, I don't want to get into politics up here because it's too dangerous a topic. It's the third rail, I certainly don't want to go there, but chances are our taxes are going to go up over the next decade or two. With the deficit where it is, it's hard to see how it could be otherwise. So don't bet too heavily on lower taxes in retirement. The other reason for kind of questioning the 80% approximation, the guesstimate for your expenses, would be that those folks who retire often want to use their first few years to travel. They're going to have higher expenses because there'll be a bunch of things that they can do now that they have time to do that they wanted to do all their life. So that may be one reason. And they may want to indulge in play golf 3 days a week or take up skydiving, who knows, more expensive hobbies. And this is all stuff that happens usually in what I call the go-go years, the first few years after you retire, when you're still young and healthy and have all this energy, and now you've got the time to do all the things you wanted to do. The third reason on here, again, gets back to healthcare. Healthcare is unpredictable, and it's possible that it can go up, or the chances are that the costs at least will go up, greater than inflation over the years. So all of this sort of questions the notion of whether 80% of your salary is really a safe number to use as a starting guess. It might be safer to use 100% or even 110, 120% just to be in the safe. But it does depend to some extent on how you intend to spend those first years of retirement. Yes, we have a question from the web.
Doesn't this number depend greatly on whether or not you still have a mortgage?
The question is, doesn't this number depend greatly on whether or not you have a mortgage? Are we talking about the 80% number, I guess? Yes, of course it does. We'll talk about that later. The assumption here is that nothing has changed in that regard. If you had a mortgage on the day before you retired, you still have a mortgage the day after, and likewise if you didn't, it will stay the same. So the assumption, the 80%, is that whatever way it was will remain that way for some years. But I will be talking about mortgages specifically in about another 10, 15 slides. So what tools are available to help you work through some of these cash flow issues? Almost all of the financial houses out there, the mutual fund companies, the brokerages, T. Rowe Price, Vanguard, Schwab, all of them, they all have retirement software available on their website. You can go on there, and the inputs for that are pretty much the same for all of them. They want to know, are you married or single? What's your age, your spouse's age, and what salary do you make, and how long do you intend to work, and what current expenses do you have, and all that good stuff. And if you input all of this diligently, then they'll crank their software to crunch the magic numbers and they'll come up with an output that basically basically tells you whether you have a surplus or not, or what required savings rate you need. Some of them run Monte Carlo simulations, which give you a probability of getting to a certain age and still have a finite portfolio left. And some of them will tell you what the remaining balance will be in that portfolio. You have to be a little careful with these, and I'll go into that in a minute, but basically the ones that are simpler to run ask you fewer of these questions, and how you put in fewer inputs yourself. But the downside is they will make assumptions for the other parameters. They make an assumption, for example, of what the return on your portfolio is likely to be, or they may assume what the inflation rate is going to be, and stuff like that. And you will find if you try 2 or 3 of them, you'll get 2 or 3 different answers. Don't try one and look to get it confirmed, that answer confirmed on a different one, because it's unlikely to happen. They can differ all over the place. But the good thing is they'll get you thinking, and if you can figure out why they're different and play with them a little bit, you can learn a lot from them. So I'm just warning you to be careful with them, and don't take their output as being cast in stone. It isn't, but they're still worth playing with. If you want to go beyond that, you can build up a full custom spreadsheet yourself, and I'm going to walk you through in the next 4 or 5 slides some of the results of doing that, and the spreadsheet is actually available on our website for a hypothetical case, and if anybody wants to download that and go into it and modify it and play with it themselves to put their own numbers in, they're welcome to do so. I would warn you, though, that you need to be fairly comfortable with Excel. This isn't a nice polished thing like you get from T. Rowe Price or something where you input 2 or 3 numbers and it will spit out an answer to you. This is something that you need to be comfortable playing it across a number of different sheets of Excel. Okay, so to do a full custom spreadsheet, you basically need to do a balance sheet first and an income and expense statement. And both of those we discussed in one of our earlier workshops. Balance sheet is simply your investment assets and liabilities, and then you do the same thing for the non-investment ones. And you might want to do that, the balance sheet will be cut off as a specific date. So if you're doing it today, you'd probably pick December 31st just passed as being an easy date to pick to do your balance sheet, because you'll have all the year-end statements available to pull the numbers off. For an income and expense statement, you might want to do for the calendar year for 2016 for the same reason. It's a nice clean end-of-year date, and you can pick out all the expenses from that. And once you have to do a ton of work for this, but once you do it, you can run all sorts of what-if scenarios. And you can ask a question like, when should we retire? Should we take early Social Security or late, or what difference is it going to make? Can we afford to travel? All sorts of what-ifs come up, and if you've built up the spreadsheet and taken the time to do it once, you can get in there and tweak it to answer a lot of these questions, and then also you can update it on an annual basis, get in there and revise it and update the numbers. So you put a ton of work into it up front once, and then it's relatively easy to update for the future events. Okay, so the balance sheet is basically, you look at all of your investment accounts, the taxable accounts, the tax-deferred accounts, the Roth accounts. You look at your liabilities, do you have any margin loans outstanding or in there? And that would give you your investment net worth. In the same way, you've got your personal assets, which are your home and your cars and all of that, less mortgage, car loans, and you come up with your personal net worth. And we're saying that for now, at least, ignore the personal net worth. We're going to plug in the investment net worth into our spreadsheet, and we'll come back to the personal net worth at a later point, if and when it's necessary to do it. But for now, we're going to make the assumption we're staying in our home. We're not going to sell it. It doesn't matter what it's worth. It doesn't matter for the time being, at least, what equity we have in it. So let's move on. The income and expense statement, obvious, what you do, you take all of your sources of income, salary, Social Security, the pension, if any, the investment income, you add all of that up. The expenses, you get your housing and the housing, the mortgage, the taxes, insurance are reasonable, or normally the big guys, the ones that are the most impact on it. You've got the necessities like utilities and food and clothing, the luxuries, and vacations, entertainment, and I have a little account that I always tack on called the UAF account. It's a slosh account, a cheater account, because frankly it's not worth spending a weekend trying to track down the last dollar. You'll drive yourself nuts. And if you just put a slush fund in there to catch all of the little items that you don't want to be bothered tracking and that it takes to balance your income against your expenses, if the unaccounted for account is less than, say, 5% of the total, then that's fine. Just consider the job done and move on. If it's above 10%, you've probably got some more work to do and go back and try to find some of the other missing items. But don't kill yourself trying to track down every last dollar. It really will drive you crazy. Okay, so for convenience, we're splitting the expenses into recurring expenses and non-recurring expenses. And you're going to love my definition here. Recurring expenses are everything except the non-recurring expenses. The non-recurring expenses, somebody mentioned the mortgage. Folks that are carrying a mortgage as they go into retirement are likely to have it paid off over the next 5, 10, 15 years or whatever, but they probably are not looking at carrying it all the way through to age 100. So that will get paid off. That will make a major step function at some point in the middle of retirement. So I've treated that as a non-recurring expense. Income taxes may be all over the place depending on where you're getting your income from. So I've treated that as a non-recurring expense. Vacations, you're likely to be doing a lot more in the early go-go years than you will in the later slow-go years. And again, it's convenient to give that its own separate account. And healthcare, I think, needs to have a separate account because you need to have the ability to model what happens if that suddenly takes a hit up at some point later on. This is only a suggested list. Other folks may not want everything on here. You may have paid off your mortgage already, for example. There may be other items, vacation home or something on here that you want to hold for the next 10 years and then plan to sell, whatever it is. But those are the kind of things that go into the non-recurring expenses. All of the routine stuff I've lumped together in one single account for the recurring expenses. That includes food and clothing and transportation and stuff. The stuff that doesn't change a whole lot from year to year other than, gets bumped up by an annual inflation rate. So rather than have, 10, 15, 20 recurring accounts and then another half dozen non-recurring, making a really wide spreadsheet, it's a lot easier to just bump all the recurring stuff, lump it all together into one single account, and then bump it up by inflation each year. So if you want to do the full custom master spreadsheet, then we'll have, the way I set it up, I'll put the first column will be the year, starting in 2016, 17, 18, all the way through to when you and your spouse reach age 100, because I want this to go out to age 100. It will include your age and your spouse's age. There'll be columns for your various sources of income. There'll be columns for the recurring expenses, and also for each of the separate non-recurring expenses. And then the final columns will be the portfolio balance. And that's basically, you go back to the balance sheet and you take your initial investment net worth from that and then adjust it each year depending on the income for that year and the expenses for that year. We're doing a quick example here of John and Jane Doe. We're assuming that they're both age 60 right now. They own their own home. They've got a mortgage, and the last payment we said is way out, 20 years or 15 years out, whatever. They've got a total investment net worth of $1.7 million. It gives, we're assuming that John makes $120,000 per annum and wants to retire at 66. We're also making assumptions for Jane, and they'd like to travel, fairly extensively after they retire. And they've got a good family history, and they're both in good health now, so they think they're going to, that they're going to live out. They need to do the plan out to age 100 in this. I hope you folks at the back can read this. you don't need to. Basically, all I'm doing is showing, the first column is the year, the second is the age, and we're talking about John's salary, Jane's salary, John's Social Security income, Jane's Social Security income, the investment income, other income, and total income, the recurring expenses, the mortgage, a separate column from the mortgage, separate for income taxes, a second for other expenses, and the total expenses. And this is just the surplus, which is the difference between the total income and the total expenses, and the portfolio value starting at the $1.7 million and getting adjusted each year by whatever the difference is between the income and the expenses. And obviously the portfolio, when they're both working, the portfolio increases in value up to about here, and then it starts dropping. And finally down here it goes negative, so you've got an oops down here at the bottom, which is not a comfortable area to be in. Now you don't need to worry about the details on this, but I just wanted to show you what the main spreadsheet looks like. It's a lot easier to understand it from this, I think. Here we're showing the dashed green line as the income, and we said that John and Jane are they're both age 60, and they're going to work to age 62, and then Jane retires, and then John continues to work, and then John retires. So after that, the only income will be from the portfolio, and that decreases out. The portfolio has run out of cash out here, so then the income goes to zero. Meantime, the expenses, this is mostly the recurring expenses back here. We said that they're going to travel, so we plugged in some extra numbers for traveling for these few years. And the go-go years, we said they've got that over out of their system at this point, and so the only thing here will be inflation. The mortgage drops off here, and then we've still got inflation, and then back out here we've added in some extra costs for health care. So meantime, the portfolio started out at 1.7 million, it crept up over 2 million, and then it dropped off fairly rapidly at first when they were traveling, and a little less rapidly until out here where it's rolling over pretty rapidly as the expenses go up with inflation, and they run out of cash at age 66. That's about average. So the 86, I'm sorry, excuse me. That happens to be about average, so there's a 50-50 chance that they'll do the honorable thing and both die before 86 on average, and everything will be okay. Or if one or both of them cheat a little and they get out to 96 or whatever, they're in serious trouble. So I would not regard this as anywhere close to an acceptable model. This is in today's dollars. Yeah, but everything we're talking about, the easiest way to understand it is in today's dollars. Yes, there is an inflator built into the model, and you see that if you pull out the spreadsheet and look at it in more detail. But it's easy just to think of it in terms of today's dollars. There's a question over here. I believe the average was 7%. The question is, what was the average return on the portfolio? And let me go back, and I can probably tell you. 6% was the number that I plugged in for that. But you can plug in your own number and whatever you feel comfortable with. Another question. The question relates to the Social Security income. It is indeed growing, and there's an inflator number that you can plug in for the. If you go back to the spreadsheet, I didn't go over that. There's a row of numbers across here, which are the inflation numbers that I've plugged in for each column. It's mostly 3% for inflation. That all of the John's salary and Jane's salary and the Social Security, everything I've assumed grow at the 3% number, but you can plug different numbers in there if you want. I've assumed 6% for the investment return, and you can play games with those numbers yourself. The slot is in there to plug in different numbers if you have a personal choice that's different. Yes.
Is that showing numbers on an annual basis? Because it's probably low for Social Security. Assuming somebody gets $2,000 a year, Social Security is like $200 a month. I'm going to assume that was monthly, but the salary income is obviously on an annual basis.
The salary, I think everything's meant to be. I think it's entered in here as a month. You're right, it looks like a monthly number. Now the question is whether that's multiplied up and included in the final column for the total income correctly. And to be honest, without checking the numbers, I can't answer that for you. There may in fact be a fault in the spreadsheet. I'm not, you may be right. The goal would be to have this column here for the total income reflect on an annual basis all of the annual incomes that are shown there. The question relates to how we convert to today's dollars. What I'm doing is actually multiplying, using this inflator for each column, and whatever way it comes out, it comes out. The easiest way to think of it is in today's dollars, but what you're actually doing is inflating it with the number, the percentage number that I have here. You can talk to me afterwards. We'll go through it. Or actually, maybe even a better thing would be to download the spreadsheet and play with it. Okay, so we've said on this one here that if Jane retires at age 62 and John retires at age 66, that may not be a great plan because there's a 50-50 chance that they will blow it. So what can they do? One of the things they can do is have Jane wait until age 66 and both retire together at age 66. So if you do that, then the income goes up through to both of them at age 66 before it drops off. The portfolio goes up a little bit higher and it drops off more slowly, so now they get out to age 91. Not great, but it's definitely an improvement. We're headed in the right direction here. What can we do to go a little beyond that? If we wait if Jane still retires at 66 and John at age 70, and now they're waiting for their travel for, it takes place after they both retired at age 70, and then the mortgage drops off here and everything as before. Now the portfolio stays intact out through roughly age 96, 97. We're not out to 100 yet, but we're getting close enough to it that I'd feel reasonably comfortable with this. The odds are in their favor here, and I'd probably be willing to accept this as a plan today, with the provision that at next year they update it, and the year after, and they can revisit it a couple of times and fine-tune it before they get to the point where Jane actually retires at 66 and John at 70, and see if they still want to go through with that. But it looks a lot healthier at this point, and they need to take these inputs to heart. Any other questions on this? Okay. There's a question at the back of the webcast.
Yeah, we've got some people looking at the spreadsheet online. So the question or comment is the investment income column doesn't appear to take withdrawals such as RMD into account. So was that
the question relates to the spreadsheet and whether it takes into account the RMD withdrawals from the income. The answer, I think, is no. That's not plugged into it because, for a number of reasons. Number one, the portfolio income column doesn't define whether it comes from a traditional IRA or a Roth IRA or where it comes for 401k or whatever, and the RMDs only apply to the traditional IRA and the Roth and the 401k, but do not apply to the Roth IRAs. Secondly, the assumption is made that if you're forced to take an RMD from a traditional IRA, it does not mean that you have to spend it. You can plug it directly back into your retirement. You pay the taxes on it and plug it back in, so you don't have to spend it. So there's nothing to do with the RMDs in the spreadsheet. With this software, regardless of whether you go with the canned software that from T. Rowe Price and Vanguard and Schwab and all of that, or whether you take the time and trouble to build up a portfolio, a spreadsheet like this yourself and customize it and take care of all the corrections that the errors that I've quite possibly made in there. regardless of how you get to your final result, there are problems that you need to face up to, and that the first problem is the old GIGO, garbage in, garbage out. I'm always very leery of somebody that gives me an answer to 5 significant digits to a question that's where I know the inputs have 10 or 20% waffle factor. You know, they're very soft numbers. So be very careful when you get an answer that it's strung out to a whole string of significant places. The output is only good as what you put in as the input assumptions. We've already said that life expectancy, you know, the actuarial tables give you the average, and they'll give you that number to 2 or 3 significant digits if you want to. You know, they know that if you average, you know, tens of thousands of people, you know, that the average is 84.375 years, but so what? You know, the question really is, you know, are you going to live 10 years beyond the average or 15 years beyond the average? And nobody can tell you the answer to that. Rate of return on the assumptions. We already said that the S&P 500 or a diversified portfolio in the past has been capable of giving you about 10% per annum, but we don't know that for the future. Sequence of return risk, we discussed the problems with that. Tax rate in the future, who knows? I mean, frankly, I'm not sure that Congress knows what they're going to do next week or next month, much less 10 years from now. So, you know, that's a big question mark. Inflation kind of depends to some extent, again, on what happens in Congress, so we don't know. Simple statement I've made here is that compounding the known unknowns for 35 years into the future is not an exact science. That's the understatement of the year, folks. There are huge, huge question marks on the answer you get from all of these, and you know, I'd love to know who said it. I don't know, but you know, they deserve a Nobel Prize. To err is human. To really screw up, you need a computer. Putting all of that together, I don't want to put, you know, that all sounds very negative on all of the retirement planning software. I don't want to put it down completely. There are uses for it, but just be aware of its shortcomings. One of the uses is as a learning tool. It's a great tool to play with and figure out how everything fits together. It's like doing a jigsaw puzzle and sliding stuff around and seeing what fits and what doesn't and what sort of effect it has. It can also give you some guidelines. You know, there are basically 2 approaches you can take for your retirement planning. You do the safety first, which means you do everything you possibly can today to guarantee that under any reasonable set of future conditions, you'll be okay. But if you do that, quite honestly, you're going to be probably shorting yourself seriously today to take care of a possible future that may never ever get that bad. The other thing is, the other way of doing it is to compromise and to figure that you don't want to trade off too much of today's lifestyle for potential downfalls in the future. You want to be somewhat rational about them, but you don't want to be totally driven by them and obsessive about them. And you know, playing with any of these tools gives you a feel for how you can make those trade-offs. They're good tools to use for any form of relative comparisons. You know, for analyzing different scenarios. You know, if you work a couple of extra years, what difference does it make? You know, if you work 2 extra years, how many years extra does that buy you on the life of your portfolio? How does playing games with when you take the Social Security benefits affect? If you take early retirement or late retirement, you know, what changes does that make to the life on your portfolio? Because if you're delaying taking Social Security, the income you need is probably going to have to come from somewhere else. So it's not just a straight given that it's always better to delay. From the limited perspective of Social Security would be better, but from the point of view of your total net worth and your total portfolio, it may or may not be. All of these tools are good for doing a sensitivity analysis. What happens if the return from your portfolio isn't quite as good as you plugged in? What happens if it's a little bit better? You know, it lets you see, you know, if you move it 1 or 2% up or down, it lets you see how sensitive is the longevity of your portfolio to that change in the return. What happens if inflation changes? So the bottom line on this is that no matter how poor the plan is, any plan is better than none. And the other thing is you can update it on it. If you have a plan in place, you can update it on a regular basis, usually once a year, and you'll fine tune it as you go along. But at least get something going so that you've got something to work off. Now we come to the tragic bit. What if I can't stretch the portfolio to age 100? What happens if I play all of these games and crank through all these numbers and there's just no way I can stretch it that thin? This is a little bit of a smart aleck answer for the first half dozen bullets here. The obvious answer: start saving earlier, save more during your working years, work longer. You can downsize your home and move to a cheaper area to keep your costs under control. You can take more of a risk and look for higher returns. Gamble a little bit more. None of those is a good solution. If you get to the point where you can't stretch it to age 100, chances are you've already forfeited all of those things, all of those bullets, and those bullets are great things to grind into the next generation of the grandkids and say, okay guys, you really, really, really got to start early. You've got to start taking it seriously now. But for those of us who've gotten to this point and find that we're struggling a little bit to see how to make a portfolio last out to age 100, there are two tools that may be of possible use to us now. One is to use a reverse mortgage to tap into the equity we have in our homes, and that's the personal net worth that we discussed on the balance sheet way back, and we said we're not going to touch for now. Well, now we'll come to the point where we may have to dip into that a little bit. And the other is to look at annuities and basically pass the risk on to an insurer. So I'm going to talk for a couple of minutes on reverse mortgages. I'm limiting myself to HECMs now, home equity conversion mortgages, which are insured by the Federal Housing Administration. All HECMs are reverse mortgages, but not all reverse mortgages are HECMs. There are a few out there that are private ones that are not governed by the FHA, and I'm not even going to touch those because 95% of what you're likely to come across are conventional HECMs, and that's what I'm talking about here. Requirements are you must be 62 years of age, old at least. You have to own the property outright, or at least have a low enough mortgage that you've got significant equity in the home. You have to occupy, you have to be the primary occupier of your principal residence. You have to continue to upkeep to maintain the property and pay the taxes and insurance on it. You can't be delinquent on any federal debt. And you've got to love this one, you must undergo, it's a 1-hour counseling session, usually done online for a financial assessment. And mostly they made this a requirement for seniors just to make sure that they understand what they're getting into. But it is a mandatory requirement. Usually it's done online by third party, and it usually costs about $100, I think, to go through it all. But it's a formality, but it does have to be done. So those are the requirements for HECM. We have a question from the web.
Yes. What's significant equity?
Question from the web is, what is significant equity? Significant, I guess, is in the mind of the beholder. If you own, if you still have a mortgage that's 50, 60, 70% of the value of your home, then it may be tough to make the whole reverse mortgage work. If you own more than half of your home, I think then a reverse mortgage could well be a worthwhile thing to explore. Those are numbers I'm just giving you off the top of my head, and there may be some slack, some leeway in it, but you need to own a fair chunk of your home outright to make it worthwhile exploring this. How much can you borrow? Well, this actually probably answers to some extent, that same question. There are two limits on what you can borrow. There's a $625,000 and change absolute cap, no matter where in the country you live. I think that's still the current cap. It was a year ago. I think it still is. So the cap is either the lesser of that, or the appraised value of your home. Now, there aren't many homes around here that are appraised for less than that. But I guess if you were in Missouri or somewhere like that, then the appraised value could be significantly lower. So that might be the cap. And you don't necessarily get to borrow that full amount It depends on your age at the time that you make the loan and on the interest rate. If you apply for a reverse mortgage at the earliest possible at age 62, let's just say you're in a home here that's worth $1-2 million or whatever, so the $625,000 cap will be the one that applies. You'll probably find that at age 62 they will only let you borrow maybe 2/3 of that, maybe $400,000 or something like that. Whereas if you're age 92, you can borrow 95% of it, probably $600,000. So the older you are, the higher you can borrow again against that cap. The reason for this is obvious. It's just that the mortgage lender is taking some risk in this, and they want to limit that risk. So the younger you are when you take the loan, the more risk they are assuming, because you're going to live a farther number of years into the future. The loan can be either lump sum or monthly payments, like an annuity. I mean, it's an annuity for life, you can think of it that way. Or it can be a non-cancelable line of credit, or it can be any combination of those. That's a useful feature. Typically, reverse mortgage loans are not repaid by the folks that are signing the reverse mortgage agreement themselves. They're repaid by the next generation. They must be repaid on the death of the owner, or they'll be due on sale of the home. The home is used as the security for the loan. So if the home is sold, the reverse mortgage will come due immediately. If the person living in the home moves out for 1 year or more, perhaps into a assisted living community or something like that, the loan will become due, and on the death of the owner, the loan will obviously become due. And at that point, the folks inheriting the home can elect to pay off the mortgage, whatever the balance is on the mortgage, or more likely the home will be sold, and the income from that sale, the proceeds from that sale, will be used to pay off the mortgage. But it's up to the heirs to decide whether they want to hang on to the home and basically buy back the mortgage, or whether they just want to sell the home and clear the mortgage that way. Question?
If they borrow like $500,000, if you have to repay it, let's say after 10 years, they would come the interest.
Oh, absolutely. The question is if they borrow, say, $500,000 against the home, and 20 years later they have to repay it, does the interest count in this? That's absolutely yes. The interest is accumulating month after month after month, and it's compounded interest. It goes up pretty rapidly, folks. So yes, the value of the loan from the mortgage company's perspective is increasing on a monthly basis, and that's what they expect to get back. Cost of a HECM can be fairly substantial. Well, first you get the closing costs to pay, which is the normal appraisal and title fees and all of that. There are mortgage insurance premiums that have to be paid because since it's a non-recourse loan, I should have made it clear in that last question, when the house is sold, if the house sells for more than the mortgage, obviously the difference, the surplus amount goes to the heirs. They pay off the mortgage, and whatever's left is theirs. If for any reason the house is devalued and sells for less than the loan, the mortgage company cannot come after the heirs for more than the value of the house. So it's a non-recourse loan. It's secured by the house, and the house is the only thing, the maximum thing that the mortgage company can get. But in order to make that a viable position, it's necessary to put some insurance in place, and there are premiums for that insurance. That's why the mortgage insurance, you're typically going to have an insurance contract that the mortgage lender will require to be funded to make sure that if the house is sold at a loss, that the mortgage lender is still made whole eventually, through the insurance, if not through the heirs selling the home. The other thing, the other fees that go in are typically fairly closing cost type stuff. Origination fees are 1 or 2%, capped at $6,000. The mortgage lender can apply a monthly admin servicing fee of up to $35 a month. Most of these fees are actually waived by, in today's environment, by the mortgage lenders. You know, you don't necessarily have to pay all of these. A lot of them are waived just by the competitive nature of, for the mortgage lenders. And those fees that are not waived, almost all of them you don't have to pay up front. Almost all of them get tacked on to the mortgage balance, and they're part of what eventually gets repaid, you know, perhaps years down the road. The only cost typically up front will be the inspection. Normally the mortgage company will charge the person looking for the loan $300, $400, $500, whatever it takes for an inspection up front, you know, for an inspection of the home. And I guess they do that mostly just sort of earnest money to make sure that the borrowers are serious about what they're doing. But almost all the other fees get rolled into the mortgage balance usually. Not always, they don't have to, but they usually do. A HECM line of credit is a tool that's available to most folks that may be a lot more useful. I shouldn't say more useful than you might think, but don't dismiss it totally, put it that way. It's worth considering for various reasons. If you elect to take your reverse mortgage as a line of credit, you have the normal closing fees up front, whatever those are, but you won't be paying, if you don't actually pull them, just have a line of credit and don't actually pull the money out, then you won't be paying any interest fees on it. And it can be very useful to have a HECM line of credit of a few $100,000 for a number of uses. What you're doing basically is converting the equity you have in the home into easily accessible funds that are available just by writing a check. You'll have no monthly payments on the principal or the interest. Once the line of credit's in place, the lender cannot reduce it or cancel your line of credit. It's not like a home equity line of credit where you have to make monthly payments and it can disappear if the lender so chooses. And the really interesting feature, and one I'd bring to your attention particularly here, is one that a lot of folks overlook. The line of credit grows over time. Supposing at age 62 you're applying for a line of credit and they say, okay, you're only 62 and we're going to lend you $400,000 or whatever it is. That line of, and you don't use it, you just leave it sitting there in case you ever need it in the future. That line of credit grows, I believe, at the same rate as the mortgage rate, say 4 or 5% per annum, year after year after year. So that in 10, 15, 20 years or whatever later, at 82, you might decide that the opportunity has come where you need it, or for whatever reason that you want access to it. It could be double what you initially had. So that's an unusual feature of a HECM line of credit. It's a non-recourse loan, so that you can never ever owe more than the value of the home when the loan is repaid. And as a last resort, it's always available if you flat out, if your portfolio, retirement portfolio fizzles out earlier than you expected. This is always available that you can tap into for monthly cash flow. I mean, we would hope that we don't get to that point, but it's not a bad insurance to keep in mind for that. Uses for the HECM line of credit. One possible use would be if you want to delay Social Security until age 70, you need something to live on in the meantime. So this is a possible source of income, for those years from 66 to 70. It might be cheaper to borrow against your HECM and then defer the Social Security to get the extra 32% bump in benefits and have those for the next 20 years. If you're into the into the bucket strategy for channeling your retirement portfolio, you normally have a short-term bucket, a mid-term, and a long-term. For example, in the short-term bucket would often be considered dead money. It's stuff that's the money that's in the money market or short-term CDs or something for immediate use over the next 1 or 2 years, and therefore putting in very little interest. So if you had a HECM line of credit, you could tap into that for any emergency that came up, and you might like that you go with a smaller short-term bucket and therefore less dead money in there. Even for your long-term bucket, it may be a good way of guarding against being forced to sell stocks in a down market. You know, if you need to sell stocks and you're in the middle of a bear market, instead of selling out at the low, it might be better to tap into your HECM for a year or two and you use that to fund it, and then wait until the market is recovered before you sell stocks. And at that point, you can, if you so choose, use the money then to pay off the HECM loan. I said before that you don't have to pay off the line of credit, and most folks under most circumstances don't. But if you're using it, for example, to get through a period of a bear market, you may choose to do so and not have the interest rates accumulate forever. Folks like Wade Fowle, Michael Kitzer, some of these guys have done a lot of research here, and the claim is that you can extend the life of your portfolio. Remember, we went from 86 to 92 to 97, so that you can move that out 2 or 3 years by judicious use of a HECM line of credit. And as I said before, the worst comes to the worst, you can actually use it to provide living expenses if the portfolio is exhausted. Yes, question.
You mentioned that if you die with an outstanding balance due on the loan, it's collected from proceeds. So listed in that is the requirement that the house has to be sold and can be passed on to the heirs.
The question relates to the paying off the balance of a reverse mortgage when the person dies. When a person dies, the mortgage must be paid off, but the heirs have the choice of paying it off whatever way they choose. If they want to hang on to the house, and if they have the ability to pay off the mortgage from other sources, they're welcome to do so. If they can't pay it off any other way, if the only way to pay off the mortgage is by selling the house, then so be it, the house must be sold. But the mortgage company will get their money up to the value of the house, and frankly, they don't care where it comes from. Another question from the web.
Do you have a slide on the negatives of HECMs? This individual has heard that you should avoid them.
The question is, do I have a slide on the negatives of a HECM? The questioner said that he's heard you should avoid them. No, the answer is no, I do not have a slide on the negative of the HECMs, but it's very easy to sum it up. The general word out there is that reverse mortgages, HECMs, are the pool of money of last resort. That's the way they're usually presented by most financial planners. That's not a bad starting point. It's not necessarily where you want to go first, but some of the negatives have been overcome to some extent by the folks doing the most recent research that I've seen in the last year or two, which suggests that in spite of their bad image and in spite of the risks, because you're putting the house, the house is the security for the loan, in spite of all of that, there are advantages, or there can be potential advantages, put it that way, to the judicious use of a HECM, but be careful. Another question from the web.
Can the HECM balance be paid off before the sale, move, or moving out, or death?
The question is, can the HECM balance be paid off before the sale of the house or before death? Yes, absolutely. The HECM balance can be paid off at any time that you have the resources to do so and wish to do so. Yes. Question. The question relates to whether the lenders need any credit criteria regarding the past history of the borrowers. I think the answer to that's probably no, in that the lenders are mainly interested in the value of the home and the condition of the home, and making sure that the home is maintained, because that's always their security. They know that if the worst comes to the worst, if their loan comes in within the value of the home can and will be sold if necessary, so they'll get their money back. So they're less concerned with the credit history of the borrowers.
So how is the interest rate established? Is it comparable with the mortgage interest rate, or is it higher?
The question relates to how the interest rate is established for a HECM. Typically, it's established competitively and usually runs maybe 1% higher than a typical conventional mortgage. Those are average numbers, typical numbers, but it's competitive. You've got to go out there and do some research. Another question.
Why is the unused line of credit required? Is that a legislative requirement?
The question relates to why the unused line of credit grows over time. Is that a legislative requirement? I don't know for certain the answer, but I believe you're correct. I think that's the reason. I've got a ton of stuff more. I'm going to have to move on here, folks. If anybody has anything else, we'll take care of it after the workshop. I want to spend a couple of minutes talking about the role of insurance, risk management. This is something that not enough of us think carefully enough about what the pros and cons are. I don't want to offend any insurance brokers or sales folks in the group, and I certainly don't want to offend anybody online or anywhere, but, and this is factual, I believe, insurance is inherently expensive. It's inevitable that it be expensive because the cost of your insurance premium has to cover, number one, the actuarial cost of the risk, number two, the overhead cost of the insurance company, and number three, the insurance company is entitled to a fair profit. I mean, we can argue over what a fair profit is, but they're entitled to a profit. So when you put all of this together, invariably it's going to be cheaper to self-insure. I mean, folks work through spend a weekend cranking numbers on the cost of, say for an annuity, if I do it myself, or long-term care, if I do it myself, I can afford this, this, and this, and so on. But that's cheaper than if I give it to the insurance company. Of course it's cheaper than if you give it to the insurance company, because on average, the insurance company the premium is going to cost more than you will pay yourself for the average conditions. That cost more by the overhead amount. Somebody has to pay for that multi-story office building and keeping the lights and heat on and paying the salaries and commissions and all of that. And like I said, the insurance company is entitled to a profit. So that's where your insurance premium goes, is to those three different groups. The whole purpose of insurance, and I'm being a little pedantic here because I want to drive this home, pretty heavily. Insurance is meant to cover a low probability risk of some potential problem that would be a huge disaster if it ever did happen. It's unlikely to happen, but if it ever did happen, it would be a real killer. I mean, think of homeowners insurance. That's a good example. Your home could burn to the ground next year, and you take an insurance policy so that it won't. It's highly unlikely that your home is going to burn to the ground next year. But if it did happen, it would sure make a hole in your retirement plan if you weren't insured. The whole role of insurance is to pass that potential risk, albeit a small probability but a high cost, pass the risk for that over to the insurance company by paying them a small amount of money, a premium every year, so that if you happen to be the unlucky person that drew the short straw, be it on life insurance or homeowners insurance or auto, whatever it was, that if you were the unlucky one and drew the short straw, they would pick up the tab for it. Risk management, the insurance is least suitable for low-cost items, that have the high probability of occurring. And the example I've given here, if you have a health care insurance, you put a major medical insurance in case you have a heart attack or need open heart surgery or something that costs hundreds of thousands of dollars, it may be unlikely that it will happen. That's a good use of insurance. But if you wear glasses and you know that you're going to get your eyes examined every year or every 2 years, you know that you're going to be getting a new pair of glasses every couple of years, that's, to my mind, not a good use of insurance. In fact, it isn't even insurance proper. It's really like a Christmas club where you're making monthly payments into something that you know is going to happen. It's not a low probability thing. It's a certainty that it will happen, sometime in the near future. So why pay the overhead cost and the profit on that kind of stuff that you can carry, that you can handle yourself? I mean, if you have to pay for a new pair of glasses out of your own pocket, it's not going to, to change your lifestyle a whole lot. So I wanted to just focus on the role of what I consider true insurance, the risk management, where you're paying a small amount of money, the premium, to an insurance company so that they will absorb the risk of some major but unlikely event happening. The one big thing that the insurance company has going for it is the law of large numbers. You and I can't know for sure if our house is going to burn to the ground in the next 12 months. But if you're an insurance company and you had 100,000 houses insured and there's a 0.1% chance that for any one of them will burn to the ground, you can be pretty sure that 100 houses will burn to the ground, give or take a few, and they can project all of that and put a dollar cost on it and average it out to see what the premium should be and so on. So they can play the large numbers game that we can't as individuals. Same thing goes for an annuity or life insurance or whatever. You don't know whether you're going to live to the average 85 or 90, 95, 100, but they know darn well that the average person is going to live, if you average spread it over a large enough number of people, to 84.75 years of age. They have all the numbers, and they can work off the averages. We can't. So that's why I wanted to consider an annuity, a single premium immediate annuity, SPIA, as one of the possible answers, if you want to stretch your income out to age 100. If you purchase an annuity to cover the necessities of life, the living expenses, that aren't covered by what you're already getting from a pension or Social Security or whatever, and that goes for life, then you can use the rest of your portfolio invested for discretionary spending, for your vacations and trips and so on. If you're going to look at any form of annuity, long before you start looking at price shopping, which gives you the best value, please look at the safety rating of the insurance company first. There's no point getting a great rate if when you come to reach out and use it 20 years from now, the insurance company is long since gone. So the real criteria that you must look at first is to make sure that the insurance company is going to be around when you need it in 20 years' time or whatever it is. For those folks who are charitably minded, you may want to consider doing a charitable gift annuity. One of the big drawbacks, a psychological drawback to an annuity that I find that folks say, well, what happens, if I give $100,000 to XYZ insurance company, they promise to pay me 6%, $6,000 per annum, $500 a month for the rest of my life. What happens if I get run over by a bus tomorrow? Well, they pocket the $100,000 and you and your heirs are out. I'm sorry, that's life, or death as the case may be. And a lot of folks, that's a sort of a drawback. They really are loath to take the chance that they will hand over a large amount of money to an insurance company and that they or their heirs will get shortchanged because they happen to be the unfortunate ones that drew the short straw. If you're working with a charitable organization, you won't get as good a rate from them, but you'll have the satisfaction of knowing that if you did draw the short straw, at least an organization that you felt was worthy of the benefit would get the benefit of getting the cash earlier. So I'm just tossing that out as a possibility. In general, annuities are more appropriate for people with middle income. Those folks in the high income bracket don't need it, and frankly, those folks in the low income bracket can't afford it. So the general concept is that it's the middle income folks that the annuities work best for.
So the bottom line is it's a bad thing anyway, right?
The bottom line, the question is a bad thing anyway. Is it? The questioner says that annuities are a bad thing anyway. I don't think I agree, but annuities have. The questioner says annuities are a bad thing because you'll never get your money, but that's not true. Supposing you pay. Yeah, let's say that you give an insurance company $100,000 for an annuity that's paying 6% per annum. So you get $500 a month for the rest of your life. If you die at the average age of 85, just say, then it's a wash for you and it's a wash for the insurance company. But if you live to 95, you're making out like a bandit. The insurance company is still paying out for you long beyond where you should have had the good grace to drop dead 10 years earlier. Yeah. Yeah. The other thing is the those people who die early are subsidizing those who live longer. And you don't know which group you're going to be in at the time you do it. That's why they can play the game of large numbers and you can't. Okay, what I've given you, I'm going to go really quickly through a bunch of this because we're getting a little short on time, folks. What I've given you here real quick is some typical rates, and don't take these rates too seriously. But what I wanted to show you was that at age 65, a male might get 6.68%, a female gets 6.4%, and you get a joint annuity for 5.65%. The man gets a higher rate because he's going to die sooner, on average. Women live a little longer, so they don't get as good a rate, and then the joint rate is lower. And again, where that continues on for the second spouse to die. These will be for a fixed amount that's not tied to inflation. The earlier you take you buy the annuity, the lower the rates are. The longer you wait, you'd expect to get a higher rate because you're going to live for a shorter time. So I just want to give you these numbers as a guide to what the typical costs. The other way of taking an annuity, I find it kind of an interesting one, is a deferred annuity, a single premium deferred annuity. And what might happen there is that somebody age 65 might go to an insurance company and say, here's $100,000, I want to start an annuity, but I don't want the payments to start for another 20 years. When I'm age 85, I want you to start paying me X number of dollars per month for the rest of my life. But between now and age 85, nothing, it's all yours. Obviously, in a case like that, you can get much, the costs are much, much lower, which means you get a much higher rate, because the insurance company gets the use of the money for a number of years before it has to start paying out. Many of the purchasers don't ever get a penny of it up because they might not reach age 85. I'm just using 85 as an example. You could do it 75 or 80, whatever you want. But it's a way of saying if your portfolio, if you can stretch it to 80 or 85, but you've difficulty seeing how to get to 95 or 100, maybe you might want to consider passing that part of the problem off to an insurance company and having them worry about it. And this is one way to do it. So many of the purchasers will never make any claim at all because they might not reach whatever age they contracted to start accepting payments. And those folks that do get to that point are going to be collecting for far fewer years. When you're at age 85, it's unlikely that you're still going to be collecting for another 20, 25 years. The other interesting thing I find interesting is that longevity insurance is not underwritten. They don't have anybody call you up and say, what's your health history? We'll have a nurse talk to you for 20 minutes and go, do you smoke or don't, and all the rest of it. It's not underwritten, which means that if you have a family history of living forever, if your grandparents and your parents were 95 or 100 or whatever, this could be a great deal. So on the other hand, if your family history isn't that good, if your parents passed away in their 60s, early 70s or whatever, you might want to say, well, an annuity might not be the best deal for me, but it's not underwritten, so keep that in mind. Yes, question from the web.
Seems to make more sense to put the money into a mutual fund that is less risky, more safe, and earn the income from that, i.e. just segment that money aside and then start using it 20 years from now.
The question on the web says it seems to be safer to put the money into a mutual fund and use the income from that instead of the annuity, and that it should be safer for 20 years from now. I question the definition of the word safer in this case. With the annuity, you have a guarantee of getting that income. And the only way you can get the guarantee from the investment would be to put it into T-bills or something, and you're not going to get the same rate of return. You might well do just as well. You might even do better, but if you want the guarantee, you probably need to go to the insurance company. No, sorry, go ahead. The question relates to whether the payments from the insurance company, whether it's taxable income or non-taxable. I'm not certain of the answer to that, but I think it can go either way. Some of them, I believe, and I'm really on pretty soft turf here, you can take a tax deduction for the contributions, in which case the income from it will be taxable, and vice versa. If you pay with after-tax dollars, then I think what you get out will not be taxable. But I'm not certain of that. There's a question this lady here.
For example, for referring to 20 years, inflation could do anything in 20 years. So are these indexed for inflation, or how is that?
The question relates to whether the numbers are indexed for inflation and how that fits in. Most of the numbers are not indexed for inflation, but you can get inflation-adjusted annuities, and it'll cost you a little bit extra up front. It's possible to go either way, but you're right. Over a 20-year period, inflation could be a critical number. The other way of dealing with inflation, by the way, would be to do a ladder effect. Take out an annuity maybe every 5 years. Split your total annuity amount into 4, and then do it at 70, 75, 80, and 85, and do it that way. There's another question at the back. Yes.
On balance, these annuities have a pretty bad reputation. And that reputation is that the cost load associated with the contract is pretty high. So going back to another person's question, would you be better off buying index fund and save the payments? Basically, using this saying instead of buying a low-cost index fund, you have to buy a managed account with high fees. Basically, the cost of doing this is going to be collected by the insurance company because they're keen to get that profit.
The question relates to the costs of the annuities, and again, whether you'd be better off with a mutual fund or with index funds. I will grant you that annuities tend to have a bad name in that the normal saying is that they are sold and not bought. They're sold by salespeople that are very often treated like used car salespeople, and you do have to be careful. Having said that, there are a number of companies out there that offer annuities on a much, much lower cost basis, but you do in fact need to look at the structure of the cost structure and who you're dealing with, and you do need to do your homework on it. But again, I come back to the question, to the notion of comparing this and contrasting this with a portfolio of index funds or funds, whatever you like. There's the uncertainty of what the market is going to do over the next 20 years, and I'm not saying you put everything into an annuity, but an annuity can be one way of diversifying away some of that risk. You don't have to put all of it into it. I need to move on because we're getting low on time, folks. I've given you again some typical rates here for male and female returns on a deferred annuity for folks that are both age 65, and we're showing that if it starts at age 70, they might get 9% roughly, and for 7.74 for a joint. And as the age goes up at which you want to start this, if you want to start it at age 85, you can get 54% for a man, 43% for a woman of your initial investment each year. But there is the risk that you'll never even make it to 85 and forfeit all of that. So, if you don't forget that the purpose here is to guard against the risk, and it is a risk of living to 95 or 100. And this is one way. It's a great thing to do if you live to 100, but that's the financial risk, and this is one way to cover that financial risk, is to pass it off to an insurance company. Again, as the gentleman pointed out, not necessarily all of it, but you can consider doing it with some of it. I want to talk real quickly about a couple of train wrecks. You put all this work into it, it's putting a great plan in place, and you've got your diversified portfolio, and you figured out how much you can withdraw each month, and what insurance policies you need, and all the rest of it. What could possibly go wrong? Go wrong. two train wrecks that I can see. One is long-term care, and the second is litigation. So let's look at each of those real quickly in turn. Long-term care, we're talking about if you need assistance with the daily living activities like bathing, continence, dressing, eating, toileting, transferring, etc., etc. Sometimes cognitive impairment is lumped in with that, sometimes not. Yes, most of the data shows that 70% of the people aged 65 or over will need long-term care at some point in their life for some period, and the costs can be very, very high. It can, be $100, $100,000 and up for assisted living facility. And what most people, or I should say, what some people, I'd even say many people, do not quite recognize yet, it is not covered by Medicare. Those folks who think, oh, Medicare will take care of this, they're wrong. Medicare will take care of, I believe, and I need to double check this, I believe the first 60 days of long-term care, if you can call it that, of care after hospitalization, and that's it, no more. So if you need long-term care for 1, 2, 3 years, Medicare is not going to be your answer. The data out there shows that men 65 and older, 58% are going to need care, an average of 2.2 years. Women, it's a higher percentage because they live longer and they'll need more years, and they were given the average there as well. Greater need for women because they live longer than men, and also they tend to act as the caregivers for men before their own needs kick in. Needs can be triggered by an accident, an auto car accident or something, or an illness, or dementia. I mean, the real challenge financially is somebody who has a dementia problem but is physically fit and could live for 20 years but still be incapable of taking care of themselves. Question from the web.
Yes. Is it okay to have a long-term care policy that could cover about half of the possible cost and then self-insure for the rest?
The question is it possible to have a long-term care policy that would cover perhaps half of the cost and self-insure for the rest? That's a great question, and in fact, I think he's stolen my thunder for the next slide or two. The answer is yes. That's one of the possibilities that's very real. Progressive types of long-term care. Initially, it might start off that folks only need little help from friends or family that maybe cook a few meals a week and put them in the freezer so you can heat them up yourself in the microwave or something like that. It might progress to the point where you need professional healthcare aides coming in for a couple of hours a day or something. Next would be a possibility of moving into an adult care center, community centers, through continued care, retirement communities, finally nursing homes and hospice. That's the progression that's available. It gets more and more expensive, frankly, as you go down the list. Costs of long-term care vary all across the states. The east and west coasts are by far the most expensive. Cheapest would be in Missouri, Louisiana, Oklahoma, Kansas, Midwest. So if you have friends or family there, that might be something to consider. I mean, you still want to be around your friends and family. You don't want to suddenly pick up all the routes here if this is where everybody is and say, I'm going to go to Missouri because it's cheaper. I mean, that's perhaps not the best answer, but if you're picking an insurance company for long-term care, the same as for an annuity, it's imperative that you check the ratings, go to Moody's, S&Ps, and Fitch, or some or all of those, and check that they'll still be around when you need them in 20 years. Median cost can be about $80,000 per year for an average, and the average stay is 3 years. So the question comes up immediately, well, I mean, if I can put $250,000 aside, can I self-insure? Yeah, you can try it, but I would say it's wrong answer to do that, because you're self-insuring on the averages, and you really need to self-insure on the worst case, not the averages. By definition, as we've said earlier when we looked at risk management and insurance in general, it's always, underline it, always cheaper to self-insure on average if you're looking at the average conditions, because you don't have to add in the cost of the building and the lights and the heating and the salaries and so on. You don't have to add in the profit. So it'll always come out cheaper if you crank the numbers. Don't even waste a weekend cranking the numbers if you're wasting your time. You've got better things to do. The real question is, what would happen if you were incapable of taking care of yourself for 20 years. Forget the average 2.5 or 3 years or whatever. What happens if you're mentally incapacitated but physically fit for 20 years? If you can't take care of yourself, but you live a long time, who's going to fund that? That's the risk that you really want to pass on to the insurance company. The problem is it's not easy anymore to pass that risk on to the insurance company. I happen to have a long-term care policy with an unlimited term limit on it. Today, most of them limit it to 5 or 6 years. I don't know of any that will go beyond that today for a straight long-term care policy, because the insurance companies don't want to pick up that risk. And they basically argue that there's no amount of money you can pay me that will make it worth their while to pick up that risk. If at all possible, you need to get an inflation rider, because as somebody here pointed out earlier this evening, inflation can make a huge difference over the next 10 or 20 years. And you'd like the policy to cover in-home care as well as at a licensed facility. You don't want to have to move to a licensed facility in order to have the long-term care policy cover it. Long-term care policies come as either single life or joint life, and the joint life are generally cheaper than 2 single life policies, and you split the benefits. One way of getting the term moved out, and I haven't really explored these in much detail, but for anyone that's interested, you might want to get into it. You can buy a fixed annuity today with a long-term care benefit built in, and I think that's a good mix. I think that's not a bad combination of it's not an irrational combination of insurance. Let's put it that way. A lot of the things that they tend to combine don't make any sense at all, but it seems to me that one could make sense. And the dollars that are used for the long-term care are no longer available for the annuity payments, but you probably don't need that, the huge annuity payments if you're in an assisted living facility and they're covering the long-term care for you. Same thing goes for life insurance. Some policies today will also have long-term care expense coverage, and again the same argument goes that the cost for the long-term care will come out of the death benefit. So those may be the only way today that you can buy a policy that goes beyond 5 or 6 years. Giving you typical costs here. Again, the earlier you start, the cheaper it is, and the longer you wait, the more expensive. And when you add in the inflation rider, it gets more expensive again. But I think the inflation rider is an important part of it, because you may not need this for 10 or 20 years. Again, these are just typical costs, just to give you an order of magnitude of what's out there. To control the costs, long-term care, I said, can be expensive, but some of the ways to keep the cost down. The earlier in life you buy it, the cheaper it'll be. We've just seen that. You should buy the longest elimination period possible. The insurance companies will typically offer policies with an elimination period of 30 days, 60 days, 90 days, whatever. That means that for the first 30 days or whatever the period is, they won't cover it, and they'll only start covering it after that elimination period. Well, most of us can cover the first 30 days or 60 days or so. So if you can get a cost reduction by going out to 90 days and still assuming the risk yourself for the first 90 days, which most of us can do, that's probably not an unreasonable way to get the cost down a little bit. And as the gentleman on the web pointed out earlier, you can consider insuring for half the rate that you need. That you would not normally think of as being a negotiable number, but if you think you need $200 a day to cover the kind of facility that you want, et cetera, but it comes up with a totally exorbitant fee to do that and you balk at it, I would at least consider a policy saying, well, what happens if I buy a policy that covers $100 a day? And there may be some way of negotiating with the facility, if they're seeing real money coming in from a reliable source month after month after month, there may be some room to negotiate. The other thing is, if you've already maximized your Social Security benefits, you may well be able to afford to self-insure for half of it and have the insurance company pick up half of it. So it's certainly a possibility. Train wreck number 2 is mitigation. What happens, if, there's all sorts of bad things can happen, and most of us have already got some coverage in our homeowners and car insurance, but we're talking here about an umbrella policy that goes the higher limits. Protects against claims for bodily injury, property damage, slander, litigation, lawsuits from libel, slander, mental anguish, and so on. What happens if your teenager gets into an accident on the freeway and you get into all sorts of litigation over it? Some of these litigation things, the costs alone can run into not just tens or hundreds of thousands of dollars. When it's all done, you can be talking millions of dollars. So if any of these settlements go against you, it could indeed be, change your whole lifestyle very, very quickly. So I would consider the possibility of buying an umbrella policy. Question here, yes. Question relates to how about earthquake insurance? That's a good question, and there's no good clean answer to it. And I have to drop back to my financial planning. It depends. Problems with earthquake insurance, first of all, is that they tend to have very high deductibles. You can get, if the value of your home is $1 million, and supposing you've got $500,000 insurance policy to rebuild on the same site and so on, they're likely to charge you at least a 10% deductible up front, so you're going to eat the first $50,000 or $100,000 yourself. Is it that high? Okay. So in general, you have to have a total disaster before you're going to get any real benefits from it, and it's expensive. But on the other side, you may want to look at it and say, supposing the worst really happened. Most earthquake damage or brick chimneys that need to be rebuilt, and $40,000 or $50,000 will cover a lot of it. And you may want to say, well, if that's the extent of it, I can cover it myself. The question, I guess, that you have to satisfy yourself on is, if the house is totally destroyed in an earthquake, can I afford that? And is it worth paying an expensive premium every year to cover it? There's no good answer to that. I don't know the answer, so it's an individual thing. I personally, frankly, do not carry earthquake insurance. Most timber-framed homes around here, if they're secured to the foundation, like I said, the problem you're likely to have is the brickwork crumbling, and the answer may be take a deep breath and turn a blind eye. I can't give you a good answer, better answer. For an umbrella policy, it does in fact meet my rule of thumb for insurance, where it's a low probability of occurrence and a very high cost risk if it did occur. You probably want to think in terms of having, if you're going to go with an umbrella policy, it probably should be $1 or $2 million minimum, because anything less than that, the insurance company is likely to say it's cheaper to settle and not even bother putting the best lawyer in court or in the negotiation to settle with it. So you want to give them you want to give the insurance company the incentive to represent you with a good attorney. $2 to $5 million is probably fairly typical. Above $10 million is unusual for anything other than the really high net worth individuals. It's not all that expensive. $150 to $300 per annum per $1 million of coverage. It might be a reasonable number if you've got a sizable portfolio that you want to protect from, stupid stuff that happens from day to day, especially if there are family of teenagers around the house. Don't mean to put all the blame on them, but we all make stupid mistakes from time to time, and it's easy to get into a situation where you might be glad you had that insurance. Okay, so next month we're going to cover safe withdrawal rates. We're going to go into a lot of detail, in fact, on Bengen's 4% rule, the RMD strategy, required minimum distributions, bucket techniques, and a bunch of other stuff. Homework for next month, in case those who want to, if you haven't done it already, set up a My Account at the Social Security website, because that gives you immediate access to all the numbers and also some software to make projections. You want to check whether you can live on your Social Security benefits and plus a pension, if any, and without pre-guessing too closely what I'm going to say next month, let's just say 2 to 4% of your retirement portfolio. Hint, hint. Consider longevity annuity if you happen to cover your fixed expenses. If you don't see a comfortable way to getting to age 100, consider looking at a reverse mortgage line of credit, a HICM line of credit, to at least see if it might be useful to you, and review your long-term care and liability insurance needs. I've given you a list of reading, of websites, and the mandatory rhymes with orange. I like rhymes with orange and Dilbert are my two favorites. You probably noticed that by now. Read from the last page to the first. It's a reverse mortgage. Any other questions? Okay, thank you, folks.